Hello, scholars, and welcome to this unit where we're going to be talking about making capital investment decisions as well as project analysis and evaluation. All of this falls within the umbrella of capital budgeting. Also, net present value and other decision criteria covered in another unit also fall within capital budgeting. So, I want to share a little message here from my first manager at Procter & Gamble years ago, Troy Czar. I asked him for an example on capital budgeting, and he said, biggest thing for me is to talk about the importance of managing cash flow. Sometimes hard for students to grasp the difference between cash flow and profit. My favorite quote, mind you, this is his favorite quote, not just his favorite finance quote. Profit is an opinion, but cash is a fact. Pretty easy to put together an easy project example that requires capital. Start with broader impact of the project, i.e. revenue might not be realized for years after the first capital is spent. Still have to service the debt and payroll the whole time, and then double check the capital budget itself. How much cash can you afford? Also important to talk about depreciation impacts and how they are non-cash. Of course, lots of consideration and rules as to what can properly be included in capital and what needs to be in a period expense. So interesting things there. We're going to cover that a lot. But yeah, don't forget, profit is an opinion, cash is a fact. Profit is a number that is an accounting figure. Cash flow is much more important for us in finance. We're trying to maximize shareholder value. Cash is king. Cash rules everything around me. We're focused on that more so than profit. So what's going to cover here in Ross Westerfield Jordan, we're going to cover chapter 10, a little bit of 11, and then some ideas on 14. So we're going to talk about valuation, process, some key terminology, some cash flow definitions, setting up the PowerPoint or the financials, and we're going to do some examples. All right, so here we go. This is our famous quote here. There are only two variables you have to plug into value any financial asset. The financial asset here is a capital idea, a capital budgeting project. That's simply the stream of cash in, which we call after-tax incremental project cash flows, or just project-free cash flows, and cash flow out, called initial outlay or investment between now and judgment day. That's the project life, discounted at the proper rate of interest, called the cost of capital or the required return or the discount rate in this case. So when you're valuing a project, you need to find the project cash flows. I'll just denote those as CF or project free cash flow. Earnings are not the same thing as cash flow. You can't just take bottom line profit and assume that that's all cash flow. There's a lot of impacts there that make those two not the same. So project cash flows are incremental. That means they're new. They come about because a decision was made. They're unlevered, so we're not caring about where we finance these from, whether it came from debt or equity. And they're after-tax cash flows from a project. So start with sales, work your way down to unlevered net income. That just means you ignore the interest expense. Next, add back your depreciation in order to find operating cash flow. Then incorporate your changes in net working capital and your CapEx, including your after-tax salvage, to get to a project cash flow. So let me just show you two different ways to do that. Maybe one of them will connect with you better than the other. So we're going to start with top line sales. Then we're going to deduct costs to get to EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Remember, we depreciate long-term tangible assets and we amortize long-term intangible assets, things like patents, but otherwise they have very similar features. We're just going to group those together and just call them depreciation. So once you have EBITDA, you deduct depreciation and you get to your EBIT, or your earnings before interest and tax. We also just call this operating earnings. Deduct your taxes to get to net income. Notice we're not going to deduct our interest expense. That's what makes the earnings unlevered. And when I say this earnings, unlevered earnings, we're talking about unlevered net income. So ignore interest expense when you're dealing with capital budgeting projects. We would include interest expense when we talk about sourcing capital, but not when we are talking about investing in capital. So unlevered net income, as opposed to net income, this is probably the more appropriate way to call it, is just unlevered earnings, unlevered net income, or after-tax earnings. When you add back depreciation, because it's a non-cash flow, you get to operating cash flow. So notice you have to deduct depreciation and then you end up adding it back. It's not fair to say just cancel those two out, you're going to deduct it and add it. The reason is depreciation is a non-cash expense. However, it reduces your taxes. So having depreciation included, deducting it out of EBITDA reduces your operating earnings, which will reduce your tax bill. And taxes are a real cash flow. So it does impact indirectly, depreciation does impact cash flow indirectly. So then once you get to your unlevered earnings or your net income, add back depreciation. We call this number now operating cash flow, or OCF. Deduct any changes in net working capital. That's your short-term financing. Deduct any capital expenditure. That's spending on long-term assets and after-tax salvage. So that's selling long-term assets. So once you take operating cash flow, less changes in net working capital, less capital expenditure or CapEx, you get to project free cash flow, or just CF. So if you remember from our unit on net present value, we were given cash flows by year. It said something like year 1, year 2, year 3, year 4, and you had cash flows here. Maybe it was an investment of $1 million that generated after-tax cash flows of 200,000, 300,000, 400,000, and 500,000. This is the cash flow we used when we calculated net present value. So now in this unit, you're going to learn how to get to that. In sales, this is not just price times quantity. This sales includes incremental sales. Could include cannibalization, halo, erosion, spillover, side effects. And we're going to talk about that in another piece. So next, you use these cash flows to use your decision criteria that we learned about: net present value, the most important one, internal rate of return, an important alternative to net present value, and then the payback period, which is a measure of time. So if you need help on those or a refresher, check out our unit there on chapter 9. You can also show operating cash flow these ways. So sometimes you see these equations shown, but you could get the same solution just by doing the above approach. Sometimes I find it more helpful for students to view it how they've seen an income statement just from top to bottom in a vertical approach. But operating cash flow is also EBIT less taxes plus depreciation, which is also EBIT times 1 less T, add back depreciation, or the probably one you see most commonly is operating cash flow equals after-tax EBITDA times 1 minus T, that is, plus depreciation times tax. This component here is called the depreciation tax shield. That's the amount of cash flow you're saving because depreciation lowered your taxable income, thereby saving you actual cash flow in terms of spending less in taxes. So remember, we took EBITDA, deducted depreciation to get to EBIT, then calculated taxes on that. So taxes are lower by the amount of the depreciation tax shield. And this is the depreciation expense per year, that is. So if the vertical approach there does not resonate well with you, I've also shown you that cash flow can be broken down this way. You have sales less costs, gives you your EBITDA. When you deduct depreciation, you have EBIT. When you take the after-tax value of that, that's just multiplying that figure by the factor 1 less T for tax rate. You get to unlevered net income. When you add back depreciation, you get to operating cash flow. And then when you deduct changes in net working capital and deduct capital expenditure, then add after-tax salvage value, you get to project cash flow. So just be careful which piece of the equation you need. All right, now before we jump into those equations and start doing some math on them, I want to talk about the process a little bit. And the typical steps in a capital budgeting process include: 1, generating ideas. And this is by far the most important step. Generating ideas. Ideas can come from any department, any division, internal, external. They can come from anywhere or anyone. Consider a wide range of ideas. Collaborate across departments. Encourage diversity. Don't rule out ideas That brainstorming step is by far the most important step. You want to consider a wide range of ideas before you start narrowing things down. This can be hard for the finance person to do because we tend to think very quantitatively, very formulaically. Once we have an idea, we like to get doing the numbers on it, calculating a lot of details on it, and just running with that. But we need to consider a wide range of ideas before we start analyzing individual proposals. So that's step two, analyzing individual proposals. We gather information on the project and we forecast the cash flows. We start to evaluate profitability and cash flow. Step three, we plan the capital budget, organize all the profitable proposals into a coordinated whole that fits the company's overall strategies. Typically, capital is limited, so we need to make choices, hence the budgeting term. We can't invest in all capital or all long-term assets that we want to buy, so we have to budget what we can. We have to consider the project's timing, priorities, and constraints, both financial and real. And the last step here is to remind yourself that you need to monitor and post-audit. This is an iterative process over and over again. You're generating ideas, analyzing them, planning the budget, monitoring, and again, going back to generating ideas. So in a post-audit, actual results get compared to your predicted results. You don't want to be overly conservative with your estimates or overly too optimistic. You want to try to be accurate as much as you can. Learn from your mistakes and get better. That no one's perfect. Practice makes progress, as they say. This is a process, so the more you can learn from your mistakes, the less likely you are to repeat them. And the only way to do that is to have a successful post-audit. And you have to be very, very brutally honest with yourself and your team to do that. Typically, forecasts are overly optimistic. It's a common fallacy there that people overestimate what they knew, and then when something bad happens, they attribute it to someone other than themselves, and then they don't learn from their own mistakes. So be very careful. Just look at your forecast. If it was overly optimistic, just be very, very objective in the post audit to say what was actually your mistake, what was actually an uncontrollable, unknown influence to that. And the idea is we are trying to hone in our own skills. So if we're honest with ourselves and we don't attribute bias to other people, other events, we can actually learn and get better for ourselves. So we reinvest heavily in profitable areas and scale down or cancel investments in areas that are disappointing. And that point brings me to a famous quote from Peter Lynch, and let me give you the background on it. Peter Lynch said, "My biggest mistake was that I was always sold stocks way too early. In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, 'It's Mr. Buffett on the line.' And I thought some of my buddies are kidding me because she was only 6. And I pick up the phone and I hear, 'This is Warren Buffett from Omaha, Nebraska.' You know, he talks so fast. And I love your book, One Up on Wall Street. And I want to use a line from it in my year-end report. I have to have it. Can I please use it?" I said, "Sure." What's the line? He says, "Selling your winners and holding your losers is like cutting the flowers and watering the weeds." And the reason this resonated with me, despite the fact that they're talking about stocks in this quote, is it also works with capital budgeting projects. Is when we invest so much into a project capital budgeting idea, sometimes we just want to invest more because we've already had so much invested in it. So we don't really tend to reinvest heavily in the profitable areas and scale down or cancel investments in the areas that are disappointing. It's easier said than done. So selling your winners, holding your losers is like cutting the flowers and watering the weeds. You really want to just reinvest in the areas that are doing well, and you really want to just kind of let go of the ones that weren't doing well, despite how much effort and time you spent on those. Those are sunk, can't get those back. That time and energy and money is just wasted. So key terms for capital budgeting is first this idea that capital budgeting is a process that companies use for decision making on capital. And capital is a project with a life of more than a year or more. Capital projects make up the long-term asset portion of the balance sheet. So when you think of assets, you have assets equal liabilities and equity. We're talking if you split this into current assets and long-term assets, we're talking about investing in these long-term assets. For now, we are going to ignore the right-hand side of this balance sheet identity. This is the capital structure side. We're not focused on where the money came from or the source of funding. We are focused on the use of funding. And in this piece here, this is the capital budgeting process. So capital budgeting projects, think of a project as just a collection of cash flows. I like to think of a project as just an idea, and projects are worth undertaking if the benefits of that idea outweigh the costs, if the benefits are greater than the cost, that is. Sound capital budgeting decisions ultimately decide the success of any corporation. Think of a corporation, big picture. They're sourcing capital and then they need to use it well. Overall, if they're going to use the funds extremely well, they have positive NPV projects. So if they keep investing in long-term ideas that have a net present value greater than zero, then the company is going to be creating a lot of value over time. So capital budgeting principles have been adopted for many other corporate decisions. They use them for working capital, leasing, mergers and acquisitions, and bond refunding. The valuation principles are similar to those seen in bond and stock valuations, so you should see some overlay here, especially when we do valuation. All valuation is comprised of timing of cash flows, the risk of those cash flows, and the magnitude of those cash flows. So timing, risk, and magnitude are very, very common valuation principles you see across numerous topics. So you could include capital budgeting in replacement projects or replacing equipment or expanding projects, just growing your product line, launching new product lines or services, regulatory, safety, or environmental, or ad hoc or one-off, or even management pet projects. So if management has an idea that they're heavily invested in, then we call those a management pet project. Capital budgeting is consistent with this idea of maximizing shareholder value. Again, if we go to our best decision criteria, which is net present value, that's a direct measure of the value created when we accept a project. So we're looking for positive net present value projects. Incremental cash flows. Those are the cash flows that are realized because a decision is made. These are the right cash flows to consider to evaluate your project. You've often heard incremental cash flows may be stated as relevant cash flows. Those are the cash flows we need to focus on. So incremental cash flows are the relevant cash flows for capital budgeting. Which ones are relevant? A change in a firm's overall future cash flow that comes about as a direct consequence of a decision to take that project. So opportunity costs are included, side effects or erosion are included, net working capital is included, tax effects are included. However, sunk costs and financing costs are not excluded. Let's go through these one by one a little slower. An opportunity cost is the value of the next best idea that is given up. So that's, if you think of going to college, for example, the cost of college is not just room and board and tuition and book fees. It's actually the cost of the cash flows you forego under your next best alternative, which may be working at a grocery store, launching your own landscaping business, or whatever. The idea in finance is you would include all of those missed opportunity costs into your decision making when you evaluate the cost of the education. Side effects or erosion, these come about because you launch one product, let's say, and if the project does really well, you launch Coca-Cola Life and you find that your Diet Coke sales increase, we consider that a side effect that, more people want to drink Coca-Cola because you're advertising this new product. So it ends up lifting, your cash flows just because you launched one idea. However, if you launch Coca-Cola Life, let's say, and people stop buying Coke Zero and they start buying Coke Life, you have eroded or cannibalized some of your own sales. So if you launch a product and your current customers stop buying what they are currently buying and they buy what you are now launching, you have to deduct all those lost sales because you're not going to get those cash flows anymore. Net working capital, I always think of this as current funding. It's your current assets less your current liabilities. So it's your short-term financing, you could think of it. Typically, when you're talking about capital budgeting, your biggest component here is inventory. So that's a big piece of net working capital because you have to stock all the shelves of all your product, fill the pipeline, and then you can start making sales after you've invested in all that net working capital initially. Tax effects, you better believe those impact cash flows. Those are relevant. Sunk costs, these are hard to ignore, but we actually say in finance you should ignore them. So this is a cost that you've spent, you can't get it back, it's sunk, you can't recuperate it. It's best to just let it go and not focus on it. Make decisions now that increased firm value based on the future cash flows that you expect to get. So it's easier said than done, this sunk cost idea. Financing costs, also ignore those. So when we're talking about financing costs, think of the right-hand side of your balance sheet. Maybe you have to issue debt at a yield to maturity of 10% and your equity has a required return of 15%. We don't use these numbers when we are looking at capital budgeting. Rather, when we're investing in long-term assets, we evaluate how risky those ideas are. How risky are the cash flows that come about because of that capital budgeting project, not necessarily the source of the funding. So those two we would ignore, and those are financing costs. So we ignore financing costs. That's the other reason we use unlevered earnings, is when we use a typical income statement. This is a pro forma income statement, a forward-looking income statement, forecasted income statement. We ignore the interest. Interest will save you money because you can deduct it from your taxes, but that's a financing choice. That's not an investing choice. So you don't include that benefit here. It actually gets picked up in a different decision. So we have to hold that off for now. Opportunity cost, like we mentioned, that's the resource it's worth in its next best use. So when you're considering college, that's the cash flows you're giving up because you're going to be spending time in the library, in classes, doing your homework, or watching cool YouTube videos by me. Sunk costs, it's a cost that's already incurred. You can't get it back. Sometimes you bought maybe a book, you realize it's boring. Do you finish the book? The idea here is no, you don't finish the book. It's a sunk cost. It doesn't matter what you spend on the book. If it's not worth your time and it's not interesting to you, you don't bother reading it. For me, this is easier said than done because I love to run. Sometimes I buy a race registration fee, and if I feel like my maybe knees are hurting, I should not go to the race, even though I spent the money. But it's hard to get that out of your mind. So even in practice, it is harder to implement these ideas. But we should do the best we can. Externalities, there's two types of externalities or side effects. The first is called erosion or cannibalization, and the second is called spillover or halo. So these side effects are the effects of an investment on other things besides the investment itself. Erosion or cannibalization occurs when an investment takes customers and sales away from another part of the company. So if we're launching a new version of Diet Coke and current Coke suppliers, current Coke users stop using and purchasing Coke and they start buying this new Diet Coke, then we have to include those lost sales as a cost of doing this decision. So it's a negative impact on the cash flows of the existing businesses. Spillover or halo, that's a lift. So maybe you launch this new version of Diet Coke and people say, wow, that looks like a really cool, innovative idea. Or maybe they're just seeing all these billboards and ads for this new Diet Coke, but maybe they go out and they start buying Coke. So it lifts the sales of your other Coke products. That's spillover or halo. That's a lift. It occurs when an investment adds customers or increases sales to other parts of the company. So that's an overall positive impact on the cash flows of a business. Now, if you're a marketing major and you're just trying to get through this course, this is a main idea for you. You really want to try to get spillover or halo. It's a lot easier said than done, though. But you'll be super, super successful in marketing if you can launch a product on the shelf, not take current consumers to purchase to lift those sales, but rather you launch one product and it lifts the sales of all your other product lines. That would be phenomenal. So pro forma financial statements, these are financial statements that project future years' operations. They're just forecasted financial statements, that is. And again, the definition for net working capital or net working capital, NWC, are your current assets less your current liabilities. When you see delta NWC or change in net working capital, that's net working capital at the end of the period minus net working capital at the beginning of a period. So that would be your change in net working capital year over year is just the increase. So you'd have to do this first equation 2 times, one for, maybe 1 year, the ending period, and then another time again for the beginning period so that you can use this to get to change in net working capital, because ultimately when you use these equations up here, you're looking for change in net working capital, not just net working capital, but the change in net working capital. So if net working capital is increasing year over year, meaning you need more and more inventory, let's say, that's equivalent. We subtract that, that's a cash outflow because you're spending all this money to build up that inventory, to fill the shelves with product and goods. All right, now when you set up the financials, there's some tips from me. So I did this for 6 years as part of my career. I'll define two different things. The first is a financial spreadsheet, and that's the financial model. And with this, I encourage you to be somewhat selfish with this. It's the spreadsheet used by a financial analyst, which aids in many finance capital budgeting decisions. Now, the reason I say be somewhat selfish with this is be protective of this. You've designed this, you've created it, you know its ins and outs, you know its flaws, its limitations, and its capabilities. If you just go around and share this with everybody, they may misuse it. They may not know the numbers as well as you, or the formulas as well as you, or the capital budgeting principles as well as you. So I caution you to make sure you use it wisely and to be careful who you share it with, just so that it doesn't get misused and then lead to an incorrect decision. However, your financial summaries, be very open and honest and clear and share these. These are just a summary of the actual financials that you should share with other department and collaborators. Now, you're probably the finance expert if you're in finance and you're working with other functions like marketing, product supply, R&D, engineering, program management, consumer market knowledge, whomever. Share your financial summaries and all your assumptions with them. Make sure you know the goal of the financial spreadsheet or the financial model. You own the model, but what you share is called the financial summary. Now, if someone asks you for your financial model, the best way to handle this is to say, what decision are you trying to influence? And once you know the decision they're trying to influence, you can decide whether this financial model is capable of answering that decision or not. And ultimately, you should only be working on ideas that impact a decision, right? That's what we're trying to do in finance. We're trying to make decisions that create value, firm value or shareholder value. Sometimes they're asking for your financial model and they don't know that it can't be used to influence the decision they're looking for. So that's why I say be somewhat a little bit selfish or guarded of your financial model. That's just to protect everybody involved. So Excel spreadsheets and financial summaries can be very complex. Consider some of these following tips. First, you want your spreadsheet organized and easy to follow. Group things by section. So put all your assumptions together, have all those dates, those names or those divisions that gave you all those assumptions. Make your input cells really clear. Have your income statement organized, your projected cash flows all in one place, and your decision criteria all in the same place. So just have everything grouped by section so it's easy to follow. Highlight what's an input cell. That's something that you actually type in, and something that is a calculation cell. So input cells feed the calculation cells. If you change the price of a product, will NPV automatically update? That's the goal. You don't want to be redoing each of these formulas for every new change in assumption. So just make your input cells correctly feed the calculation cells. So when you share a financial summary, be very careful. Your peers outside your finance department should understand what you share, and it should help them make better business decisions. Second, after we talk about organize, we want to be clear. Include the date of the model. You typically work on these things every week or every day. Assumptions change frequently, and you don't want someone running around with an old summary with old data. So put a date on your summaries and your models. Assumptions should be clear. Specify units. Is it $1 per unit? Is it a number of units, millions of units, or millions of dollars? Are they years, percentages, etc.? Just be super clear on your units. When you share spreadsheets, you ultimately are responsible for your model. So be careful when you consider who else can run the numbers, run the model. Running the model is not the final step. An effective analyst will need to consider many other factors, including how to influence decisions. And one of my favorite books is actually by Cialdini called Influence. So if you need help with that, if you're a finance major, you may want to look up Robert Cialdini and his Influence book. So third, we want the financial model and summary to be flexible. Assumptions and inputs should be easily changed so that we can see a new output. This allows better for scenario and sensitivity analysis. Scenario analysis is the investigation of what happens when you change multiple inputs on a certain value. So maybe you change price and volume and cost in one scenario to see what happens to NPV, whereas sensitivity analysis is the investigation of what happens when only one variable is changed. So maybe you change price and you say what offering a different price would do to net present value. So this can be reapplied for use in other projects too. If it's flexible, it'll save you time. You don't have to set up all these formulas. You set them up once, you've checked that they're accurate. This allows you to work on more projects and then thereby influencing more decisions. If you're in front of more people and influencing more decisions, your career will go much faster. And lastly, we want to make sure this is accurate. In a world of so much uncertainty, we want to be certain in our mathematics. So when you have a spreadsheet, use this control squiggle, Uncle Worm there, is this, I think it's called tilde, control tilde shortcut to see which ones are formulas and which ones are inputs. So design and build your own model, test it out with numbers that are easy to verify. You don't want to make a mistake here on math. There's enough uncertainty in this world that we don't need to be uncertain there. So here's an example. I just copied and pasted different parts from an Excel model. Notice anything that's in yellow is an input cell. So the volume is an input cell, the price is an input cell, the cost per unit is an input cell, fixed costs, etc. Project life, equipment, tax rate, net working capital, and cost of capital. Anything else is a calculation cell. So we don't need to update these cells down here. A pro forma income statement, we can just take price times quantity, price times volume, that is, to get to sales. So these two numbers multiplied together will give you sales. Variable costs, again, that would just be volume times cost per unit. And then fixed costs, you would just bring down your fixed costs and link those cells. You don't have, so the idea is you're not typing in these cells, you're linking them. So this first cell would be equal to your volume times your price. And then this cell would be equal to year 2 volume times its price. And then year 3 is equal to that volume times price. So work all your way down from sales, less cost, less depreciation gives you EBIT, less taxes gives you that unlevered net income. Then what you need to do is work on your net working capital in your fixed assets. So you get your projected capital requirements. Then, favorite part here is we focus on the cash flows. We get to calculate cash flows. Then you pull out EBIT, add back taxes, add back depreciation, deduct taxes, and you get to operating cash flow. So operating cash flow here is your EBIT, add back your depreciation, and deduct your taxes to get to operating cash flow. Then once you have operating cash flow, you take this project operating cash flow, or OCF, deduct capital. So your net working capital every year was 20,000. So every year you had 20,000, including year 0. Your change in net working capital after year 0, it's an increase of 20,000, but then the change here is 0. There's no incremental beyond the 20,000. So that's, be careful there. Sometimes there's an error there. So the change was an increase. You deduct the changes in net working capital because that's an investment. Usually that's things like inventory. So if you have to build inventory, in this case, think of this as it costs you $20,000 to fill the shelves with your product. But then you get to recoup at year 3. You get to recoup all that, sell everything off the shelves, and then you get that back. So notice net working capital at the end gets fully recovered. Capital spending here, this is your long-term asset. That's the CapEx, capital expenditure, or capital spending. Sometimes out here you have after-tax salvage, so just be careful if you have to calculate after-tax salvage. If you get to sell the equipment, the property, the equipment or whatever, then you put that value in here, but you only get to keep the after-tax value. So if you sell something for a gain, you have to pay tax on the amount of the gain. So sometimes there's a number out here. So just watch that one as well. Once you have your cash flows by year, so now we have the cash flows, the total project cash flows by year, we go back to what we learned in chapter 9, and that's just discounting the cash flows, calculating our net present value. Net present value here is greater than 0, so we should accept. We have an IRR. The IRR is 26%. Our cost of capital was 20%. That exceeds the hurdle. So that's greater than 20%. So we would accept. So ultimately, the decision is accept. Since NPV is positive, the firm should accept the project. And then this is just a nice note. The IRR exceeds, so 20%, so 26% exceeds the 20 cost of capital, which would give us the same conclusion. But again, the focus should be on net present value. That's by far the most important decision criteria. Again, watch that chapter 9 video if you need more help on that. Here's just another example to go through. If anyone wants me to post these models, I'd be happy to do that. Just leave me a comment and I can share these with you, and you can see all of these sections would just be calculations based on what's up here. One nice thing I like to do is I like to put units on everything. So if they all follow the same units, then I put the units at the top, and then it's just for that whole section, everything is in dollars, just like these are all in dollars. This whole section is in dollars. Again, all of this is in dollars. And then your net present value, we should maybe state that's in dollars. Your IRR is a percentage. But here, volume is a number of unit, price is $1 per unit, fixed cost is $, life in years, equipment in dollars, rates. Also, put your assumptions together when you get them. Who gave it to you? Maybe it's your market knowledge team, or feel free to put a name in there and a date. That way, if there's a new update, you can just send them a quick email and say, hey, last update I have from you is from May 10th. Do you have any new numbers I should be looking at or not? So any assumptions, just put right there on that line item. I also have this kind of pet peeve. I like all my columns to be the same. So this whole column is all for my year 0 things. Notice in year 0, that's current, that's today. All of these are assumptions I'm making today. The equipment cost, my current tax rate, the cost of capital, and ultimately a decision being made today as to accept because NPV is positive. And then the next column is all of my year 1 elements, year 2 elements, and year 3 elements. That's just easier on the user so that they're not sometimes looking at years as columns and then years as rows. It just makes it easier. And when you share a financial summary, as much as possible, I like to fit it all on one page. That way, when you hand it out and go over it with everybody, everything's on one page. You've got your name there. You've got the date. Feel free to use some of your own color schemes, but as much as you can, try to make your work look like yours. So maybe using the same color and the same layout. So when they have a handout, you're building your own credibility. If they've worked with you before, as soon as they see this, they know this is your work. They know it comes with a level of expertise, and they've maybe had a good experience with you before. So you get to kind of build your own brand as you share these things. If your work kind of looks sloppy, or if it changes every time, you're opening yourself up into more questions about, is this credible? Have I seen this before? Is this the same as we did last time? Is this new? Should I be concerned? But everything here fits on one page. You have all of our assumptions and where we got them, all the key figures. So I would print something like this out, hand it out. I would not share the actual Excel model, but maybe a PDF of this and print out of this, along with maybe a memo as to your own recommendation, maybe some comment on some sensitivities about net present value, any concerns you have with the project, etc. But in terms of a talking piece, this would be a great one-pager to walk your team through as to the value of this idea. All right, so how'd we do? We did actually pretty well here. Everything was organized. It was grouped by section. We highlighted certain cells that were input versus calculation cells. We have dates of model. We have our name. We have units specified. Again, just be careful sharing spreadsheets. Be fine sharing summaries, but with the spreadsheet, you don't want that misused. You want to help them come to better decisions. So be a part of that process of decision making rather than just saying, here's a model. I'm not sure how you're going to use it. But typically, if things go well, they get the credit. If things go badly and the model gets misused, it could come back to you. Again, people like to attribute their errors to other people as opposed to themselves. So just watch out. It's a natural human tendency to do. There's another approach to get to the operating cash flow, and I want to show that for you here. There's one baseline approach is to take EBIT, or earnings before interest and tax, add back depreciation and deduct taxes. However, there's another approach where using the depreciation tax shield approach. The depreciation tax shield is the tax savings that result from the depreciation deduction, calculated as depreciation times the corporate tax rate. So to get to operating cash flow, notice these are two equations. They both calculate operating cash flow. See, they say operating cash flow equals. But in the second one, we have sales less costs times 1 less the tax rate plus depreciation times tax. So depreciation, it's not shown here, but just be careful with your depreciation expense. It is per year. So that would just be maybe the cost of the equipment, less salvage. For most of your intro courses, we just depreciate straight line to 0, meaning that salvage is 0. So it's just cost over years. That would be the depreciation line, then times the tax rate. So this component here, depreciation times tax rate, is the depreciation tax shield. So in our case, this project, since we depreciated this versus expensed it on the income statement, but rather we depreciate it, that means we recognize it as an asset, and then every year accumulated depreciation against it to bring that net book value down to 0. That's the amount of money we saved because of depreciation. That saves us money in taxes. So in this case, how much money does depreciation save us in taxes? That answer is $10,200. All right, so this is a good point here on changes in net working capital as to why it impacts why profit is an opinion and cash is a fact. Well, the reason is GAAP. Sales are recorded when made, not necessarily when cash is received. So cash in is sales less a change in accounts receivable. Cost of goods sold is recorded when the corresponding sales are made, whether suppliers were paid or not. So cash out could be COGS less change in accounts payable. So those items that are on an income statement may or may not be cash yet. So you have to be careful. So here's some advice. Ponder these things while you go through the math here. It's very common to drown in the details or be attracted to complexity, but what's most important to me is to know what 3, 4, or 5 major characteristics of the business really matter. I see my job primarily as asking the right questions and focusing the analysis in order to make a decision. So there's a few pieces in here I like. The first thing is, as a financial analyst, sometimes we think our job is to just present the net present value, do a really good detailed job of that, and then walk away. However, we want to focus our team on what are the real big drivers of that net present value, double click into those, make sure we understand them, see if we can leverage them to get more net present value, but really focus your team on what drives net present value. Why is this a good idea? Why is this idea creating value? Why should we accept this project? Ultimately, we're not doing this just to get to better numbers, but we're using it to influence a decision. And our decision in capital budgeting is whether we invest in this idea or not, whether we purchase this capital or not. So again, spend a lot of your time getting the numbers right, but don't forget, ultimately we're trying to get to a decision, and the numbers are probably going to be wrong anyways, because the idea of you forecasting cash flows that are 4 years out and assuming they're 100% correct is kind of ridiculous. Focus on the variables that really matter, try to make sure those come true, and then focus the team and the analysis on making a good decision. And then this is one that has helped me a lot in my capital budgeting projects. Charlie Munger, I look up to him quite a bit. We have a passion for keeping things simple. So us finance folks, sometimes what we like to do is double click. If we love numbers, we tend to find safety there. So we like to hone in on the numbers, calculate more numbers, prove more numbers, get more decimal places, and feel more confident in our work. But don't forget the big picture here, that you're influencing a business decision. Why does that decision make sense? Should we do it or not? And ultimately, more details may not necessarily help you. So keep that in mind. Let's talk about evaluating net present value principles. And some of this comes from chapter 11, which is project analysis and evaluation. Let's talk about 3 definitions. First is forecasting risk. That's the possibility that errors in projected cash flows will lead to incorrect decisions. If you are overly optimistic in your cash flows, maybe your net present value is too high and you ended up accepting a project that you shouldn't have accepted. And then these 2 definitions get mixed up quite a bit from students: scenario versus sensitivity analysis. Scenario analysis is the determination of what happens to net present value estimates when we ask what if questions. That means we're changing multiple variables at the same time. So we might change volume and price to see what happens to net present value. Whereas in sensitivity analysis, it's the investigation of what happens to NPV still, but only one variable is changed at a time. So we just change price to see how sensitive net present value is to changes in price. So just be careful. Scenario changes multiple variables, and sensitivity only changes one variable at a time. I love making these data tables. Again, if you're interested in these, I can just share these models with you. But from the numbers we saw above, I just took a base case number here, and these were ways I would help influence my team to see if there was any other low-hanging fruit with a project. If our base case volume here, that's what's in blue, is 50,000 units, and our base case price is $4 a unit, our base case net present value is maybe 10 million, that is, whatever. In this case, it's $10,648. But if there's any way we can increase volume while holding the same price, maybe we get an end cap or we put some product next to the checkout line, we get an extra 50% value creation in that idea if we just deliver more volume. Or if we can charge just a little bit more, how can we maybe change the packaging or whatever to get 10 cents more in price? Look what our NPV does. It changes from 10,000 to 17,000. So these kind of visuals can help other members of your team say, hey, net present value is not just maybe this number, but we can still have some leverage. These are some of the variables that really deliver the value in this case. Now, your NPV is going to be very sensitive to your required return or your cost of capital, that is. So be careful here. Don't fudge these numbers. That would be unethical. You want to make sure that the cost of capital is commensurate with the risk of the project. And we'll talk about different ways you could get to that in a little bit. But if your discount rate or your cost of capital is really 20%, then your NPV is this. Now, it is sensitive to this number. I have seen analysts change this number to get the decision they want, but long term, that's going to lead to really bad decisions, and it's probably just straight up not the right thing to do. Speaking of Charlie Munger here, here's a quote: "All I want to know is where I'm going to die, so I'll never go there." Here are some pitfalls. Here's where you're going to die in capital budgeting: not incorporating an economic response in the investment analysis. Business is extremely competitive. If you found an idea that has a net present value that's very positive and you launch this new product, you're a fool to think your competition is just going to sit by and not launch a similar product to try to take some of that value from you. So incorporate an economic response. Typically, that's faster than we think it's going to be. Or you misuse capital budgeting templates. Maybe you use somebody else's template that was built for a different project and you used it. Maybe there was an error in that, or it wasn't meant to do a replacement project, but instead it was meant to do a new project. Management pet projects, these are projects that management really, really wants to see done, and sometimes they're willing to overlook some flaws and not treat them as maybe objectively as they should. Or they base an investment decision on earnings per share, net income, or return on equity. These are accounting-based numbers, not necessarily cash flow numbers. So that would be a bad way to make a decision. Or you use internal rate of return to make investment decisions. You want to use net present value. Remember, internal rate of return can mislead you on mutually exclusive projects. So sometimes it can accept the project with a lower NPV because its IRR is higher, but you want to focus on NPV, or IRR can mislead you if the cash flows are non-conventional. So if there's more than one sign change, IRR could also get you a different decision. Bad accounting for cash flows. If the accounting's wrong, the cash flows are also probably going to be wrong because we make adjustments to those accounting numbers to get to cash flow. Misallocating overhead costs or not incorporating them, not using the appropriate discount rate. I've talked to you before that you could change that number to get a different answer, but not using the appropriate risk adjusted discount rate. A lot of people use the weighted average cost of capital to discount a project, but that only works when the risk of the firm matches the risk of the capital budgeting project itself, which is very, very rare. So again, you are not focused on the discount rates or the interest rates, the yield to maturity on debt, or the required return on your shareholders. You're looking at how risky the project is, and then you're using a discount rate that's commensurate with that level of risk, not the sourcing. Or you just spend all of the budget because that's what's available. If you watch The Office, you've seen that Michael did that in one episode. Or failure to consider investment alternatives. Remember, the most important step in capital budgeting is that idea generation phase. As finance people, we like to just jump in and calculate numbers and maybe go too fast through that ideation phase. Or you mishandle sunk costs. We should ignore sunk costs. We should include opportunity costs, but often I have actually seen analysts include sunk costs and ignore opportunity costs, which is the opposite. You want to ignore sunk costs, so cross off sunk costs, and you want to include the opportunity costs. So took those from CFA. Thank you very much. So using the sensitivities and scenarios, just, in business speak, they say know the levers that move the needle. So what are the levers? What are the variables that make a difference on net present value? What about it leads to a positive? What about this investment leads to a positive NPV? Make sure you can talk about that as opposed to saying, well, this is the NPV because I calculated it accordingly to the formula. That is not a really good business answer. You should know why this project creates value. You should be able to tell a story behind it that matches the numbers. So sometimes what I did to prepare for meetings is I would change each variable one at a time by a factor of 1%. So I knew going in, if I were to get a 1% lift in volume, let's say, that would create another $1,000 in net present value. Or if I were able to change price 1% upward, that would change my net present value by $2,781. That way I wasn't constantly saying like, well, I don't know what that would do. I'd have to go back to my cubicle and calculate the mathematics behind it. This gives you a little bit of understanding of like which variables really matter. So if you have somebody that's really, really talking about equipment is the most important piece of your analysis, you can step back and interject and say, hey, really what we need to focus on is ways to increase volume or increase price on this project, and get your whole team focused on those variables that really make that business idea successful. Focus on those big levers, make a decision that impacts those, and then walk away from some of the other elements that are a little bit smaller and may not impact net present value as much. But you would be able to help your team do that. Your other team members don't know that. They don't run the financials. They may think what they're working on is the most important thing. You can step back and tell them, these are the pieces that make NPV positive. These are the variables that will deliver more NPV. Let's rally the team around delivering those levers and make this idea even better. So this is from a marketing professor. He went to Subway and they asked, "Would you like avocado on your sub?" And he was just blown away by this idea and thought, "I wonder how much money that actually makes Subway." Just to ask everybody else, "Would you like a little add-on?" So what's our avocado? What's the thing we could take our current idea, add a little bit, get a little bit more cash flow from everybody. Tornado diagrams can be useful. Those are good ways to demonstrate something like this, to say, hey, puts a range on each unit. So maybe you have a base case NPV here. We had about 10,000. Maybe the range on volume was from here to here. And you have some, maybe that increases it. It could decrease it 1, or it could increase it by 5, or price, maybe somewhere in this range. But each variable is plotted accordingly, and it kind of looks like a tornado if you do it, but that's very similar to what we did up here. Monte Carlo simulations, this can add clarity if many of the inputs have a wide range of possible outcomes. You can run thousands of iterations to see what would change in net present value. It may still lead to the same decision, but you would get a better idea on risk in just terms of the probability your NPV doesn't come to fruition. Use data tables like I did above. Don't forget the competitive response. We typically underestimate the level of competitive response. Again, if you have a positive net present value project, that means you have a really good idea that's creating a lot of value. Your competition is going to want a piece of that. And so don't forget that. Now let's talk about a little bit from chapter 14, because this is cost of capital on a firm. I think of this as weighted average cost of capital. I'm going to address each of these questions because a student sent these in to me and I was really happy. Does it matter what interest rate I use for a new project valuation? And in fact, it matters very much. You need to compensate investors for the use of capital to finance new projects. The cost of capital with an investment depends on the risk of the investment. If the investment is risky, it will have a higher cost of capital. So here's an important takeaway. The cost of capital for a project depends on the use of the funds, not the source of the funds. So that goes back to that balance sheet identity where your assets equal your liabilities and your equity. Maybe your yield to maturity on your debt is 10%, your required return on your equity is 15%, but we're not using those. That's the source of funds. We're focused on what long-term assets are we going to invest in, what capital that is, are we going to invest in, how risky are these projects and these cash flows. So this discount rate could be 20%. It could be 12%, but it's related to the risk of the idea or the project. So again, the cost of capital depends on the use of funds, not the source of funds. We handle the source of funds in a different decision way. We have an entire chapter on that, which we can talk about, but we want to separate those ideas, how we invest funds and how we source funds. How should I think about interest rates in projects? So let's talk about these. The correct discount rate depends on the riskiness of the projects. We use discount rates or cost of capital on investments in projects. When we have a positive net present value, that means a project adds value to the firm. It means a project's return exceeds what financial markets offer on investments of similar risk. It's really hard to come up with ideas with positive net present value because businesses, like we said, are so competitive. They're all rushing to find ideas that create more value than they cost to undertake. That is, they have positive net present value projects. The minimum required return is called the cost of capital with the project. What interest rates do I use when valuing a new project? Well, examine what capital markets have to offer. Use that information to estimate a project cost of capital. And there's a number of approaches you could use to take that. What is WACC? We have a whole unit on that later on called the weighted average cost of capital, or WACC. That's the cost of capital for the firm overall. That's the required return on the overall firm, not necessarily for a particular project. Projects can have a cost of capital that's in excess of the WACC if they're riskier than the overall firm, or lower than the WACC. Again, it just depends on how risky that project is. If that project is risky, it has a higher cost of capital. Can I think of these terms interchangeably? Required return, appropriate discount rate, cost of capital? Yeah, more or less. You can use those interchangeably. They essentially mean the same thing. So one more slide here. Cost of capital, again, that's the minimum required return on a new investment. You often hear it called required return, appropriate discount rate, or just cost of capital. Use it for new projects. When you have the weighted average cost of capital, that's the cost of capital for the firm as a whole. It's the overall required return on the firm. Use this for the whole firm. A component of that is the cost of equity. That's the return equity investors require on their investment in the firm. Then cost of debt, that's the return firms' creditors demand on new borrowing. Think of that as the yield to maturity. So the after-tax cost of debt for the firm is that pre-tax cost of debt, or the yield to maturity, times 1 less the tax rate. So when you incorporate these interest rates together, cost of equity and the cost of debt, you can use those to get to the weighted average cost of capital. So you take the weight of your capital structure that's invested in equity times the cost of equity plus the weight of your capital structure that's in debt times the yield to maturity on that debt times 1 less the tax rate. These last two components, these last two factors are the after-tax cost of debt. Again, we're going through this pretty quickly, jumping ahead of ourselves just a little bit. I just wanted to make sure you don't discount a project at a firm's WACC. You would only do that if the project has the same risk level as the overall firm, but typically that's not the case. Now, if you want to see other ways to get to the cost of equity, here's two main ways to get to cost of equity. That's the return equity investors. You could use the dividend growth model. We'll get to that in a future chapter, or you could use the SML. I'll put those here for now. Pause the video here because we are going to talk about this in another unit, particularly when we get to stock valuation. And then when we get to, so stock valuation is chapter 8. And then when we get to SML and CAPM, we're going to talk about that when we get to chapter 13. And WACC was actually chapter 14. But I wanted to throw some of those pieces in there because I know interest rates can get confusing for students. So I want to provide some clarity now while I had your attention.